Hey everyone, we're looking at Dave Ramsey's take on whole life insurance. It's completely skewed, it's completely wrong. He misses a lot of things. Let's dive into the video.
So I had two questions regarding whole life insurance. I know your general principle, but I've never actually heard you discuss these two characteristics of whole life insurance, or these two scenarios. So I was kind of curious of your opinion regarding this subject, if you don't mind.
Sure. I'm an expert on my opinion.
So the first question is like this. Today in America, if a single person is earning $150,000 a year or less, they can put up to $7,000 into a Roth IRA that grows tax-free. But at $150,000 after taxes, about $130,000, a single person pretty much anywhere in America still has plenty of money. So let's say you're putting money into that investment brokerage account. My question was on whole life insurance. It also grows tax-free. I know it doesn't have the same rate of return, but if a person wanted to increase their long-term tax-free savings, would that be something you would consider as a viable approach, that they've already maxed out their Roth IRA, or if they have a company, a Roth 401k, they still can only max out at $7,000?
Yeah, how long ago did you take your job selling whole life?
I've only sold a couple of policies, but no, I don't. I'm not actually involved in the industry specifically. If you don't.
How did you sell policies if you're not involved in the industry?
Oh, I am a licensed agent, but I haven't done it in a few years.
Because you pretty much spouted their line perfectly. This is the whole life sales line. That's how I knew you were selling it. You nailed it. Like you were just trained like 3 weeks ago. That's what it sounded like. Not picking on you, but you are representative of the industry. Okay, so let me help you with this. Whole life does not grow tax-free.
So Dave is correct about that. Whole life insurance cash value does not grow tax-free. It grows tax-deferred. But what Dave fails to say or recognize is that all the growth and all the gains on cash value can be used 100% tax-free. And in the policies that we structure, there's a lot of growth, there's a lot of gains. You're going to hear Dave say that there are no gains. That isn't true. Dave primarily is talking about old style whole life, not about a properly structured high cash value whole life policy.
Okay. Unless you lose money. And your basis for tax purposes in a whole life policy is the total of your premiums. So if you pay in $100,000 over a bazillion years into your whole life policy and your cash value is $90,000, you have lost $10,000. And so, of course, there's no taxation. Or you can borrow your own money and pay them an interest rate to borrow your own money. And by the way, 100% of the time, borrowed money is not taxable.
Borrowed money is not taxable. But when you take a policy loan, you are not borrowing your own money. Dave is wrong about this. You're borrowing from the life insurance company. They have a general account. You take a policy loan, they give you money from their general account. They put a lien against your cash value. Dave also says if you have $100,000 that you've put into the policy and $90,000 of cash value, if you cancel the policy, you're going to lose 10 grand. But the policies that we design have more money growing in cash value generally than what you've put in premium. So the scenario that I would say is if you put in $100,000, you're probably going to wind up at some point with $200,000 or $300,000 in cash value. That money is able to come to you through a policy loan, 100% tax-free. If you take a $200,000 loan and you have $300,000 in cash value, you're still earning interest and dividends on your $300,000 of cash value. Dave doesn't tell you this. And you did not borrow your own money. That's why you're still earning interest and dividends on the $300,000 total.
So whole life in and of itself does not grow tax-free. That is a falsehood.
And that is true. It grows tax deferred, but you can use the money 100% tax free.
Mm-hmm.
If it actually made money and you took the money out, it would be taxable.
If you withdrew the money and you had gains, it would be taxable. We don't recommend that. We recommend policy loans. Once you hit retirement, you withdraw the amount of money that you put in, which is basis. Then you take policy loans thereafter, which is a way we teach you how to have tax-free money in retirement. 100% tax-free retirement income using a properly structured high cash value whole life policy.
But they never do because they suck so bad. The rate of return is horrendous and the fees are so high. And so, no, I would never consider that.
You know what's interesting is Dave recommends that you buy term insurance and invest the difference. And he'll tell you you're going to earn 12% returns in your mutual funds, which historically isn't even accurate. But did you know that less than 2% of term insurance ever pays a death benefit? Whole life insurance is a guaranteed payout to your family, beneficiaries. It allows you to leave a legacy. What Dave is encouraging is if you have term insurance and it lapses in retirement or when you're 65, there's no more coverage, which means you now have a lot of pressure put on your assets to perform, because without life insurance, your assets, your brokerage accounts, your 401ks, those become your life insurance for you. Whole life insurance provides a permanent death benefit. So, is term insurance okay to have? Yes. But understand that less than 2% of term insurance ever pays out. So what that means is that 98% of people are throwing money down the tube into a term insurance policy, which is like renting a house. There's nothing to show for it for 98% of people that have term insurance. Now, I'm not saying don't ever have term insurance, but what I am saying is there's tremendous value to having whole life insurance because there's a permanent death benefit. Dave is going to talk here in a minute about the life insurance company keeping your cash value and you only get the death benefit you paid for. That isn't true in a properly structured policy. The policies I design and we have here at Insurance and Estates, the death benefit grows. So let's see what he has to say.
As an option. Instead, I would, listen, dude, if you put your money in a fruit jar as your side investment after you maxed out a Roth, you're going to end up with more money than you will screwing around with a whole life policy.
And that isn't true. Traditional whole life can make money. Properly structured whole life with paid up additions will always make money. You'll make money. And in most cases, in my 27 years, the analysis that I've done, you're going to outperform your 401k, your IRA, your mutual funds. 9 out of 10 times, a properly structured whole life policy will outperform what Dave is recommending, stock market and mutual funds, because there's no losses. You never lose money in a properly structured whole life policy. What Dave is suggesting, mutual funds, stocks, IRAs, 401ks, there's volatility. There will be years you lose money in those accounts. I'm not saying don't ever have one of those accounts, but Dave leaves out a lot of the negatives about the market and mutual funds and exaggerates whole life issues. What he says primarily is not true.
Because they lose money.
I'm impressed that you sniffed that out as quickly as you did.
Too much time in 30 years being hated on by whole life people.
That was pretty impressive. I'm not going to lie. I'm impressed.
Yeah, well, I mean, it's a scripted thing that
clearly
it's tax-free growth, which is a complete lie, y'all. It's not tax-free growth. If there is growth and you take it out, it's taxed. Mm-hmm. Mm-hmm. Period.
Again, if it's a withdrawal, it would be taxed, just like any other investment. But we're not saying take money out as a withdrawal. Use policy loans so you have tax-free money coming to you.
But there never is, because the rate of return is so horrible and the fees are so high. So here's the way whole life works for those of you listening. And he's talking about it as an investment only, but let's talk about it as an insurance product, which is what it is purported to be. And you only have to have a life insurance license, not a securities license to sell the crap. So which is easy to pass. If you can roll out of bed, you can probably pass your life insurance exam. It's not that hard. Securities exam, on the other hand, very hard. Now,
by the way, I've taken all of these tests. A life insurance exam is just as hard as a securities exam. So again, Dave wants to talk as negatively as possible about whole life insurance. But I've always wanted to ask Dave a question or two. And I would ask this: why do banks and major corporations have billions of dollars of permanent cash value insurance? Why do the wealthy and business owners have these policies? Right? There's a reason. They understand, Dave, that there are tremendous benefits to Tier 1 capital where your money is growing guaranteed. You have access to the cash. You can use the money, the gains and the growth 100% tax-free. This is an asset that's been around for nearly 200 years. So, Dave, you're misleading people. These blanket statements that you make, they're incorrect. So don't buy into everything that Dave says about whole life insurance here.
Whole life is 20 times more expensive than the same amount of term on the same person.
What Dave is saying is 20 times more expensive. If you look at the cost day one, that might be true. But if you insure your entire life with term insurance, did you know term insurance is the most expensive form of life insurance? Why? Because you have to renew it every 10, 20, or 30 years. If you're going to do a true apples to apples comparison, if you live to the age of 90 and you have term insurance to the age of 90, so there is a death benefit that will go to your beneficiaries, you would have paid more money, higher cost, higher premiums overall in your term insurance policy to keep it to age 90 than had you just started with a whole life policy.
So a 30-year-old buying a $100,000 policy, if, say, for instance, they did that for $5, whole life would be $100. Okay, so where does the extra $95 go above the cost of insurance? Because term is only insurance.
That's right.
It goes into an investment called cash value, which is what he was bringing up. Okay, the investment called cash value, the first 3 years on a whole life policy, your investment growth is zero.
Not true. And you're going to see that right here in this illustration. This is a traditional whole life policy on a 30-year-old. And you'll notice there's a guaranteed column of cash value and death benefit and a non-guaranteed column of cash value and death benefit. The only difference between the two is the dividend. That's it. So when the dividend is paid in year 2 of $179, you see the cash value. So in year 1, there is no cash value in this traditional whole life. Year 2, there's $179 because of the dividend. Year 3, there's $4,224. And what you're going to notice is that the death benefit of $853,000 grows over time. So notice also that the cash value, I'm going to look at a different page here to show you that starting year 11, he would have put $110,000 into the policy. He has $111,000 in cash value, and the death benefit grew to $939,000. If he passes away at the age of 90, the cash value is $3.59 million. The death benefit is $4 million. How much premium would he have put in? At that point, $600,000. So $600,000 turns into $3.59 million in cash, and a $4 million death benefit. What Dave is saying is only the $800,000 death benefit would have been paid out to his beneficiaries. Not true. If he dies at the age of 90, $4 million would have been paid out to his beneficiaries.
100% of your $95 a month in our example, the extra 19 times you're paying for this, you get zero in your investment. So you open a bank account and you put in $95 a month for 3 years and the balance is zero.
No one would do that, by the way, if they understood that.
They do it all the time, but no one would do it if they understood that. You're right.
And Dave's just talking about the first year. But there is compound growth in a whole life policy. We saw there 600,000 turn into 3.5 million. Dave doesn't talk about the compound growth of cash value.
Right, which is our goal here, is to make everyone understand it. Then once it does start making money, the average whole life policy in America today averages 1.2%.
It's higher than that. Even if we look at the traditional old style whole life policy with no PUA, just 10,000 a year going into base, in 60 years at the age of 90, there's $3,592,000 in cash value. What's the rate of return? Here's the 10,000 over a 60-year time frame. The rate of return is 4.92%, as if you would have earned 4.92% every year, not just in the 60th year. And we know this because at the age of 90, 60 years out, there's the cash value, $3,592,000, which matches perfectly the illustration. 4.92%, not 1.2%. That is a tax-free number. What I'm going to show you here in a few minutes is in a properly structured policy, cash value is higher and your rate of return is higher.
With an inflation rate of 4.7.
Losing money.
And so after you get past those two things, here's the worst part of the whole thing. So this little couple buys a $100,000 whole life insurance policy. They pay into it for 20 years. They have $20,000 in there finally after they got 1.2% and has nothing for the first 3 years. And then he dies. You know what they pay? They pay the life insurance.
Just the premium.
The face amount. What happened to the money I've been paying $95 extra to build up in my savings account? Insurance company keeps it.
Not true. Dave, oh my gosh, you're so wrong here. I just showed in an illustration the death benefit grows. First year death benefit, $853,000. If this person dies in the 10th year, the death benefit grew to $923,000. If this person dies at the age of 65, there's a $1.69 million death benefit. And I already showed if they died at the age of 90, a $4,057,000 death benefit. So Dave, please stop telling people that if you have a whole life policy, that the insurance company keeps your cash value. That is not a true statement. There's a growing death benefit, even in traditional whole life. We're going to see it better here in just a minute with a properly structured policy. This is a properly structured policy. It has paid up additions, PUA, to turbocharge the cash value. Notice that the first year cash value after the $10,000 premium goes in is $8,200. Dave doesn't understand these properly structured policies. We reduce the death benefit and add a term insurance rider. So here we have a makeup of $96,000 of whole life coverage and $193,000 of term insurance. The term insurance eventually drops off the policy, but all the person purchased here was $96,000 of whole life coverage. In 10 years, if they pass away, there's a $607,000 death benefit, even though they purchased $96,000 of whole life. At age 65, the cash value is $940,000 and a $1.6 million death benefit. So if we add up the $940,000 plus the $96,000 death benefit they purchased, let's just round it up to 100, that would be $1,040,000. But if they die, what would they actually get? Their family would receive $1.6 million. This is more than the whole life coverage and the cash value combined. At the age of 90, 3.45 million. What's the death benefit? 3.8 million. So if you add up the 3.46 with another 100,000 of whole life coverage that was purchased, that would put you at 3.55. What does the family get? 3.87. Dave is absolutely dead wrong when he says that the life insurance company keeps your cash value, not with the companies that we recommend. We only use the top mutual insurance companies in the industry. These are dividend-paying, properly structured whole life insurance policies.
You do not get the face value plus the cash value.
Well, let me ask this, because...
And I just proved that that was wrong, dead wrong.
Let me finish.
Okay,
right quick.
We could say that the cash value is a function of the growing death benefit. It's true, you only get the death benefit. But what I clearly pointed out here is that the death benefit is growing and the cash value is driving the growth of the death benefit.
So you have a savings account that the first 3 years you put money in, they keep all of it. After that, you make 1% on it. And when you die, they keep your money. Who would open this savings account? Nobody.
Dave, be honest, be fair. What you're saying is not true. And I just showed it in two whole life illustrations, traditional whole life and the new style, properly structured high cash value whole life.
But people do every day. It's the biggest, let me tell you, it's the payday lender of the middle class. It's crap.
Not true. This is why wealthy banks and major corporations have these policies. Dave's blanket statements are harmful to people. Do not believe everything that he says about whole life insurance.
Sorry, Andrew, but you asked.
So when do they, a guy like Andrew, if somebody said, I'm interested, let's say they had built up a certain amount of cash value, when would a guy like Andrew say, here's the right time to get at that money so it's all a risk game, but so that you can get it before you die?
Whoa. It's not a risk game. Whole life insurance is a fully guaranteed product. It's guaranteed in a properly structured policy. You're going to make money every year. You're earning a guaranteed interest rate and you're earning a dividend. It's true that dividends aren't guaranteed, but the companies that we use and recommend, they've all paid dividends 120 plus years, 150 plus years, 175 plus years. So we do consider that you'll get a dividend. We just don't know what it will be from year in and year out. But whole life insurance is fully guaranteed to make money every year. There's no risk of losing money like there is in a mutual fund or a stock investment.
Well, you can't get it before you die. The only way you could get it is cash the policy in.
Not true. You can take policy loans.
Because if you borrow the money out
then you're paying
before you die, they repay the debt to yourself to make sure they keep the whole cash value before they pay out the face value. So if you borrowed $20,000 in a $100,000 policy and you died with the loan out, you get 80 instead of 100.
Oh my gosh.
They pay back the loan so they make sure they get to keep it.
But in a growing death benefit, let's say you have $3 million of death benefit and $2 million in cash value. If you take out $1 million loan and you pass away, yes, the million's going to be reduced from the $3 million death benefit, but your family still gets $2 million, and you only purchased, in what I just showed you, $94,000 of whole life insurance. The math is amazing when it's a properly structured whole life policy.
Wow.
So the only way to get to keep the money is to cash out the policy.
And then at that point, why get it to begin with?
And you have lost money on it, so it's not taxable.
Terrible.
No, you're better off putting money in a fruit jar, darling. At least when you die, it's there.
So clearly we've seen in the illustrations I've presented that what Dave is saying is inaccurate. It's grossly wrong. Properly structured whole life is an asset. It grows guaranteed every year. You have access to the liquid cash. You have tax-free money that you can use now and into retirement. You have permanent death benefit. Use this as asset protection. Use it for legacy planning. So many benefits we don't have time to get into today, but I hope this has been helpful for you to see that whole life insurance, when it's properly structured, is so much more than what Dave Ramsey makes it out to be.